Hi everyone, I want to elaborate a little bit more on one topic. It's again hedge accounting. I found out that many of us, corporate treasurers, are concentrated on hedging strategy, and this is naturally the most important part of hedging. But I want you to think about hedge accounting as a part of hedging strategy, and I will briefly explain why. Follow me. Okay, we have company A that has hedge accounting in-house, and we have company B that outsource hedge accounting completely. Okay, what are direct expenses here? Expenses direct. Company A, 0. I mean, it's simple strategy, it's done in-house with no additional cost. Company B, it's probably 50, 70 USD, thousands. Maybe less, but usually you know how it works. Then the company knew, and it thinks it's a way more complicated than it is in reality. It hires top consultant to cast hedge accounting for something relatively simple, for example, forward contracts or options on currency. I mean, it's really simple because for accounting purposes, especially if you're hedging something straightforward like operating expenses, it's usually critical terms match approach, and you don't have to have a efficiency test on regression analysis. You don't need that actually. You need something with low cost, and you can find it for 10, 20, 30, I would say K, pretty decent. But normally you go with this one because you just don't know. But these direct expenses are not everything you need to take into consideration. You have also indirect. Company A, again 0, it's all in-house. But for company B, how much do you think is it? It depends on many factors. What I'm referring here to is to your trading partner. If you are here, you don't care who you trade with. It's either top 4 US banks or local boutique UK FX trader that provides you the best trade. And that's it. That's all you need to trade, the best conditions. But here you start thinking, okay, bank A doesn't provide me hedge accounting because they don't allow to do so. But a lot of mid-tier brokers provide that option for free, kind of for free. But it's not for free. It's for additional forward points. It's for additional price for options. And from my experience, it's visible on forward contracts. For currency exchange, they normally charge between 50 to 100 BPS, basis points, in comparison with big banks that are not allowed to provide you hedge accounting. And they provide you hedge accounting kind of for free, but for this additional charge. I'll translate it to percentage. It's 0.5 to 1%. Okay, so what's your total here? Obviously here is internal expenses measured in time of the team. but let's assume it's zero, because externally you are not paying anything on top what you normally pay to your exciting accounting team. Here, it's already, okay, let's assume it's 50. It's $50,000 and 0.5% to 1% from the volume you trade. If you trade $10 million equivalent, 1% from 10 million, it's 100. 0.5% is 50. If you trade 100 million, okay? Keep thinking for yourself. But it adds up. It's accumulated cost. To have flexibility, you have to solve that problem for you. You have to have your hedge accounting in-house. That's my advice to you. And I mean, it's just one-off exercise. You sit, you go through a standard, you decide what's applicable for you, what's not. You engage consultant, obviously at the stage 1, stage 0, then you're deciding, then you're checking what to do and what not to do from the hedge accounting perspective, and then you're fine. Then you should avoid this one, and please avoid it. It just doesn't make sense to do it. Okay, see you.